Hey everyone, welcome to this quick and easy introduction to managerial accounting, a key subject in any business course here in the Philippines. Let's break it down fast and simple. First off, what is managerial accounting? Unlike financial accounting that's for outsiders, managerial accounting is for internal use. It helps managers make smart decisions, plan strategies, and control costs. The goal? Improve the company's future performance. So let's compare financial accounting to managerial accounting. First, let's talk about time focus. Financial accounting tells you what already happened, what is the past. For example, how much did we spend last month? But in managerial accounting, it is forward looking. It is looking at the future. It asks how much are we going to spend next month or what will happen if sales go up. So that's the difference between financial accounting and managerial accounting. Financial accounting talks about the past, and managerial accounting is for the future of the business. Financial accounting has to follow specific rules in the Philippines. This includes the GAAP, or the Generally Accepted Accounting Principles, or the PFRS, which is the Philippine Financial Reporting Standards. These reports needs to be clear, consistent, and legally correct. But with managerial accounting, there's no need for strict rules. Managers can create reports in any formal format that helps them make fast and smart decisions. Next is the users of these reports, or the one who uses these reports. So in financial accounting, the people who uses these reports are external, or out or the people outside the company, like investors who want to know if the business is doing well, or the BIR that checks their taxes. While in managerial accounting, it is for people inside the business or internal in the business, like managers who make decisions every day. So in financial accounting, it is for outsiders, and managerial it is for the insiders of the company. Lastly is the frequency or reporting time. Financial accounting reports are done on a schedule, monthly, quarterly, or yearly. This is good for tracking company progress and reporting to the BIR or the investors. But in managerial accounting reports, it can be made whenever needed, even daily. Like if a manager wants to check if a new promo is working this week, they can ask for a quick report. So how does it helps in decision making? Managerial accounting plays a big role in business decisions, like budgeting. It helps managers plan how much to spend or earn in the future. Cost analysis. This shows where the company is overspending, so action can be taken. Performance evaluation, where managers use it to see how well a department or branch is doing. Pricing decisions. This helps decide the right price for products or services. And make or buy analysis, where it helps decide whether to produce something in-house or buy it from a supplier. With all of this, managerial accounting gives managers the data to make smart, informed decisions. Here's a simple example. Let's say a Jollibee branch notices that food waste is high. So, using managerial accounting reports, the manager finds out which items are causing the most waste. So they adjust their operations, and as a result, the waste goes down and the profits go up. So that's how managerial accounting helps in real business situations. So in summary, managerial accounting is used inside the business. It's focused on the future, and it helps managers plan, control, and make better decisions. So thank you for watching. Don't forget to like, comment, and subscribe.